Hi there folks, now in this week's lesson I want to talk to you about what I think is one of the most popular forms of technical analysis out there. Goes alongside the support and resistance, and that is the moving average. Moving averages are factored into many different strategies out there. Some you may have developed yourself, or some you may be trading at the moment. So I want to explain to you exactly what the moving average is, the different types of moving averages, and how we can best use them. Now we also have a cheat sheet which you can download in the description tab as well, basically summarizing a lot of what I'm going to be saying to you today. So make sure you download that. Okay, let's get straight into it. Now, moving averages, there's plenty of different ways that we can use moving averages in our trading, and also there are different forms of moving averages as well. So that's basically what we're going to cover. In fact, here is a summary of what we're going to talk about over the next few minutes. I'll explain to you exactly what the moving averages are, how they're calculated, and so forth. We'll look at the different types of moving averages as well, because it's not just the one way of calculating. And then we'll look at the different ways that you can use the moving averages in your trading. You can use them for entries and stops and predicting trends and so forth. So we'll look at the different ways that we use moving averages in our trading. And then what I'll do, I'll jump onto the screens, I'll pull up some real live charts, put on some moving averages and see if it all makes a little bit more sense when you see that. Right, okay, so what is a moving average? Well, a moving average basically is a trend following indicator. It basically averages out price over a period of time. Now, the moving averages are lagging indicators. What do I mean by lagging indicators? Well, basically it means they print after the price has actually recorded its price. So they are lagging behind. So unfortunately, they don't predict the future. They show what's happened in the past. That's why they're called lagging indicators. It'd be great if they could predict the future, but no, they lag behind price to show us what price has done in the past. And also the slope of the moving average is very important. So a rising slope, as you see in that little picture there, a rising slope would indicate potentially a rising trend is in play. If the slope is falling down, then that would indicate that the trend is going lower. Now, a lot of people are talking about moving averages these days with the COVID, you know, the number of cases and the number of fatalities and so forth. What's happening to the moving average? It's basically looking at the event and averaging it out over a period of time. As I say, there are three different types of moving averages. Now, a lot of you, I get a lot of questions asking, what's the difference? Which one shall I use? The exponential moving average or the simple moving average? Some even ask about the weighted moving average. So there are three different forms of moving average that you may hear spoken about when it comes to trading. Quite honestly, I think weighted, we don't really bother too much about that. It really is just these two. I'll explain to you the difference as well, so you then will have a better understanding of which one you want to rely on. So let's have a look at the simple moving average. Now, for those of you that are not mathematically inclined, don't get too worried about the formula. Basically P1 plus P2 up to Pn divided by n. It's just simply an average. So for example, here we have a 5-period moving average. So if you add all these numbers up, you come to 45. Okay, so you add them up, it comes to 45. If you divide that by the number of entries, in which case there'd be 5, divide that by 5, it would give you a moving average of 9. Okay, so this is how the moving average works now. So at the end of a particular time period, be it a 5-minute chart or be it a hourly chart, 4 hours, what have you, a new price is recorded. And the previous number in the equation, the first number in the equation, gets dropped out of the equation. So for example, we'll take off 7 and we'll add on, say for example, a new number. So here we add now 8 plus 9 plus 10 plus 11 plus 14. I've got to find out what that adds up to because I did the calculation beforehand. That comes to 52. And if you divide 52 by 5, that moving average comes to 10.4. And clearly I did that calculation before I came on camera. So you see here the moving average has moved from 9 to 10.4 because we had a higher number come into the average. So this moving average is sloping up. And of course, as numbers would go on, the 8 would drop off, the new number would come into the calculation, and of course, whatever that number is, averaged out will show you which way the trend is going. That's basically how you work out a simple moving average. Now, when you look at moving averages, we've just looked at a 5-period moving average. But we always look at moving averages in terms of how many we're averaging over. And we look at them as a fast, medium, and a slow moving average. So a fast moving average has a few numbers. This is just, broadly speaking, I would say anything less than 10 periods when you're looking at a chart is a fast moving average. And it moves more in tune with price. So the lower the number, the more relevant or the more precise it will be to price. So for example, if you had a 1 moving average, in which case it's not a moving average at all, it's just basically 1 period, it would be bang on the price. If you average it out over 2 or 3, it would be very close to price. So the medium moving average, I would say, broadly speaking, anything between 10 and 40. Okay, that will move to a lesser degree to where price is going. So basically it'll be a smoother moving average than the faster moving average. And when you go out to the slow moving average, maybe this is anything over 50. Anything above 50 would be considered to be a slow moving average. Now I remember from my days in the city, the technical analyst would come in the morning meeting. Pretty much all he spoke about really in those days, back in the day, was the 200 period moving average. A lot of the banks, a lot of the analysts always talk about the 200 moving average. So the slow moving average will be a much smoother curve because obviously one number in the calculation doesn't have a massive effect because of course it's averaged out over a large number of actual prices or numbers going into the calculation. So you've got the fast, the medium and the slow. And you really like to look at moving averages with these in conjunction with each other. Okay, so now let's look at the exponential moving average, often referred to as the EMA. Remember the calculation on the simple? Well, this is slightly different. Now, I'm not going to actually give out the formula in here now. It just bogs everyone's mind down. But basically, what it does, it gives more weight to the most recent number of the calculation. And that is quite important when you're looking at determining the trend. And the reason being is when it is not so affected by when an old price from way back gets knocked out of the equation. Let me explain to you how that works. Let's assume here you've got 10 numbers going into the calculation. All 5s, apart from the first one in the calculation, was 20. Now if you add all those up, it comes to 65. If you divide 65 by 10, it would give you the average price of 6.5, clearly. So think about this now. Moving average, the first number in the equation drops out. So we drop off the 20 and let's say we add on another 5. Now we've got 10 5s going into the equation. 10 times 5 is 50 and that would give you a an average of 5.0. So you can see here the moving average has gone from 6.5 to 5, but nothing's really happened. All we've done is add on another 5. So in reality, price is staying flat. But because this number dropped off the equation from way back, the moving average has been affected. And we don't necessarily want to see that when we're looking for trend. We don't want old numbers dropping off the calculation adversely affecting the moving average. So think about that. Exponential moving average, sometimes better used for trend following, more realistic of what actually is happening to the trend. Right, so how do we use the moving averages? Okay, so they're used for multiple ways. I love looking at moving averages to determine for me the trend. I like to see moving averages that are fanned out, like you see over there. If they're fanned out and there's no crisscrossing, that's normally for me a good visual that the trend is pretty strong and going in a particular direction. If they're crisscrossing, then normally that means that there's no real trend or there's indecision in that trend. So we use the multiple moving averages to see the trend. Fanned out gives a good indication of a strong trend. You can use these for dynamic support and resistance. What do I mean by that? Well, basically as price moves, the moving averages will move. A lot of people will say if it comes back up to the 200 or the 50, that's going to act as a support zone or indeed a resistance zone. So a lot of traders will use these as dynamic, i.e. they're moving support and resistance zones. If it gets up to the 20 moving average, that's where I'll be selling. If it comes back down to the 50, that's where I'll be buying, for example. So they're used as dynamic levels of support and resistance. They're also used for pullback areas to enter a trade, like a gap close. Often traders will have strategies where they will say it's got to pull back, close the gap on say the 8 or the 21 moving average, and then the trend will continue from where it came. So again, we'll look at a gap close on a moving average, another great way to enter a trade and looking at the pullback. And moving average crossovers are often used for entries as well. You may have heard of the golden cross. Golden cross is basically when the fast moving average crosses through the slower moving average. I think the actual definition for a golden cross is at the 50 moving above or below the 200. So it's not necessarily a fast or in itself, but the faster of the two crossing over, moving average crossover. It's a common way that a lot of traders enter the market. So you may hear them talk about the moving average crossover. And lastly, we use these for stop placement. So for example, we could be in a trade and we will look to exit the trade if it closes above or below a certain period of moving average, indicating potentially that trend is over and it may be looking to reverse. So there's plenty of ways that we can use these moving averages, and I think the best way now to show you those is by jumping onto a real life price chart and see the moving averages in action. So come on, let's go. Okay, so here we are on a typical MT4 trading platform. MT4, MT5, pretty much the same. In fact, any trading platform that you're using will be the same type of format in terms of inputting your technical indicators, moving averages or what have you. So for the sake of this short lesson, we'll look at MT4. I want to start off by looking at the difference between the exponential moving average and the simple moving average. So first off, we go to Insert, Indicators, Trend, and select moving average, and that will come a panel where you can select the different moving averages and the time period. That's basically the look back, how many candles the average is being worked out. So here we have got an 8-period exponential moving average. I'll change that, say, to 20. Exponential, clicked there, and we'll make this a light blue, so aqua color, and we'll put that on there. So that's the exponential moving average. Now compare that to the simple moving average with the same time period. So we go to Insert, Indicators, Trend, Moving Average, and we'll change that to a simple moving average, and we'll just make that a different color so you can see the difference. And there you are. So we have the exponential moving average in light blue, and the purple moving average is the simple. You can see there's not a huge difference. Now, if you're entering trades on dynamic levels, i.e. looking at these for entries, then maybe it's better to use the exponential, because obviously that is not so widely affected by large numbers falling off the calculation. But in terms of the trend, the direction of the trend, as you can see, they are pretty similar. Now, for the sake, again, of this short lesson, I am just going to stick to the exponential moving averages. Now, what I want to do is compare the slow, the medium, and the fast moving average, so you can see exactly what they look like. Okay, so I am now going to input a fast moving average. It's going to be the exponential moving average, and the fast will say a 10 moving average. Normally these are applied to the closing price, by the way. Others open, high, low, but the standard I think that everyone uses is really the closing price. And we'll colour this one magenta, and in goes the 10 moving average. Now you can see it moves pretty much with the price. It's basically hugging the price because the average is worked out just over the last 10 candles. So this would be a fast moving average. Now let's put in a medium moving average. So we'll make that 20, and let's colour that, say, yellow or something like that. Okay, so you can see it's not actually sucking into the price. It's moved away from the price for pretty much all of it because the average is worked out now over 20 price actions. So it's not so sensitive to the movement in price. So that is a medium term moving average. Now, if I want to put in a slow moving average, say put in the 50 or the 60, you can see again it's less reactive to the price. So often the higher period moving average can give you a clear indication of the trend. So there you have the fast, the slow, and the medium term moving average. Okay, so now let's look at the different ways that you can use these moving averages. Now on this price chart I've got the fast, the medium, and the slow moving average. Now look back down here. You'll see here that the moving averages are all crisscrossing. They're pretty much closing in on each other. This is a good indication that the market is in range, that there's no particular strong trend in place. So, for example, if you are a trend follower and you see this type of moving average display, then you may want to sit back and wait for the market to break out into trend. Now look here, you see the moving averages. They finally break out into trend and they are indeed fanning out. Fanning out moving averages is a good indication that the trend is in play. If you see this on the higher time frame charts, there's a good indication that the trend is reasonably strong, giving you potential entries on the lower time frame chart. So a fanned out moving average display is a good indication of a strong trend, certainly as opposed to this type of array where they're all closed in on themselves. So one way that people use moving averages is looking for a pullback into a moving average, be it fast or medium or so forth. Let's assume now we want to have a moving average entry where we pull back into the fast moving average. You'd have had an entry there. Nice bullish engulfer there as well. Market's still in trend. We pull back, we touch the moving average there. That's another entry there. We have some entries there as well. Had you played the 8 EMA touch on this trend, of course, you'd have had some profitable trades. You'd maybe lost a few here. Down here again, the moving averages are moving in on themselves. They're closing in. So you would step away and you'd leave the trend alone. You wouldn't be buying into this trend. Okay, then we start fanning out again and we look again for a pullback. Now remember, the faster the moving average, the lower the number, the more in tune to price it will be. But that is one way that people use moving averages, is a pullback into a faster moving average for trend continuation. Okay, so another way that traders use moving averages are to tell you when to exit a trade. So for example, if we're following a trend, we may look to see a close above or below a certain moving average in order to tell us to exit the trade. It's a great way to stay in trends for as long as the trend wants to continue. So for example, if you're in this trend and you've entered here on a 8 EMA pullback, you'll still be in this trade. Let's say we want to place a stop once it closes below the medium moving average. So here we'll see the medium moving average, the yellow line. We have a close, so you'll basically maybe enter once the market closes below that moving average. So we can enter potentially on a touch and pullback. We can exit on a break and close above or below, say a medium or indeed even a slow moving average. And obviously there's lots of different permutations that you can use, lots of different strategies that you can apply, but with all strategy development, I suggest you backtest this vigorously over all the past data to see indeed if indeed your strategy has an edge. So that basically is stop levels through a moving average. And another way that traders use the moving averages are moving average crossover. So when the fast moving average crosses through the medium or indeed the slow moving average, that could give you an entry level. So here, if you look to the left, you've got the fast moving average. That's the purple line, basically in tune with price. It's trading down, nicely fanned out. Could be in a downtrend here. But then here, the purple line, the fast, crosses through the medium moving average and crosses through then the the slow moving average. That could indicate that an entry is in play. So moving average crossover, it's called. So you'd basically enter there. Remember, these are lagging indicators. That basically means that the moving average is lagging behind the price. So you do need to certainly put this through some back testing as well. But indeed, it is a definite strategy play that many use, is the moving average crossover. And of course, you can use the moving average crossover to determine when you exit a trade as well. So the moving average crossover is indeed widely used by many strategies. Now, some of you may have heard of the golden cross. Now, the golden cross typically refers to a moving average crossover of the 50 moving average crossing through the 200 moving average. So some traders, for example, will be looking at this chart. This is the 200 moving average. Price is above the 200 moving average, meaning we're only taking long trades. Then we apply the 50 moving average and look for the crossover. Okay, and there you have the 50 moving average crossing through the 200 moving average. That could indicate a change in the bigger trend. A lot of the analysts talk about the golden cross when the 50 crosses through the 200. So here you'd be only looking at buy trades. Now we've seen the cross, you'll only be looking at sell trades, again on the higher time frame. So the golden cross is one to certainly pay attention to, and you may now see it and recognize it when you see it on some analysts' reports and so forth. So these are the basic ways that we use the moving averages, the exponential and the simple moving averages. There's lots you can do with a moving average. They don't predict the future. They are lagging indicators. But if you apply these to some back testing, you sure can find a very simple strategy deriving from these. Okay, so I hope you found that useful. Hopefully now you've got a bit of a better understanding about moving averages, how you can potentially incorporate them into your strategy development. Now, you can download the cheat sheet below me here. You can get it laminated, stick it on your desk, and therefore you got a point of reference. Now, I release a video every Monday as well, discussing trading opportunities, what's driving the markets for the week ahead. So make sure you watch that, and if you hit the bell notification when you subscribe, you'll be notified the moment that has been released. Of course, I am streaming with my colleagues here at Forex Signals up to 6 times a day. If you want to take part, come and join us in the trading room. Just hit the free trial down below. There's a 7-day trial. You can come and see what it's all about, absolutely free. I'm sure you're going to love it. If not, nothing to lose there at all. Okay, I'll see you next week. Have a good one.